DSW, Designer Shoe Warehouse, is the one-stop shop for all your footwear needs. With sneakers, boots, and everything in between, for every style, mood, and occasion, you'll definitely find shoes that get you at prices that get your budget. DSW has what you need, but more importantly, they have what you didn't even know you wanted. You never know what you'll find at DSW. Find the shoes that get you at prices that get your budget at DSW stores or dsw.com.
This podcast is supported by MIDI Health. Are you in midlife, feeling dismissed, unheard, or just plain tired of the old healthcare system? You're not alone. In fact, even today, 75% of women seeking care for menopause and perimenopause issues are left entirely untreated. But it's time for a change. It's time for MIDI. MIDI's not just a healthcare provider. It's a women's telehealth clinic founded and supported by world-class leaders in women's health. Their clinicians provide one-on-one, face-to-face consultations where they truly listen to your unique needs. They offer a full range of holistic, data-driven solutions that isn't one-size-fits-all care. This is care uniquely tailored for you. At MIDI, you will find that their mission is clear: to help all women thrive in midlife, giving them access to the healthcare they deserve. Because they believe midlife isn't the middle at all. It is the beginning of your second act. Ready to feel your best and write your second act script? Visit joinmidi.com today to book your personalized, insurance-covered virtual visit. That's joinmidi.com. MIDI, the care women deserve.
Welcome back to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. This week on the podcast, we are going to continue to reflect on some of the most pivotal moments in the market. We are going to look at the market when it first began downtrending. We're going to discuss GDP as well as working on building our investment portfolio during down markets. Before we get into this week's episode, I wanted to let you know that on Patreon in January of 2026, I am bringing back the Abundance Plan Reimagined. Since 2020, I have hosted what we call the Abundance Plan, which is a way to reflect emotionally on money and identify how we are currently experiencing money and how that is impacting not only our decisions about money, but how we are currently generating money and how our beliefs on money can be currently limiting us of generating more money. This has been an all-time fan favorite, and I am so excited to bring it back for January of 2026. If you want to join us for the Abundance Plan Reimagined, which is a program that lasts approximately 2 months, head over to patreon.com/investies and join us on the exchange tier. Enjoy this week's episode from March 25th of 2025. We finally broke a 4-week losing streak in the market. This is a much welcome relief. The weeks before last, 4 to be exact, were all losing weeks. And so it's nice to experience this relief, especially as investors. While last week's modest rebound was encouraging, it's definitely not going to turn into a rally or anything like that. We can only expect things to get a little more turbulent as we anticipate tariffs on April 2nd. And then, of course, as we anticipate GDP numbers at the end of this month. So we still have a lot of news that is going to make the stock market pretty volatile. We're going to get into GDP and we're going to talk a little bit more about tariffs. But before we get into that, I just want to go ahead and go over how we performed last week. And then I also want to go over how we performed in the last 6 months, and then some reminders on patterns in the market. Last week, the Dow Jones grew by 0.95%. The S&P 500 grew by 0.3%, and the NASDAQ grew by 0.7%. All of this growth took place in 1 week. I know that's not really impressive, but you know what? A win is a win, and I'll take it. I think it at least tells us that the stock market is settling in right in and around these levels. At least it's not another loss. Of course, I think it is bracing itself for the potential news that is ahead of us. I wanted to also go ahead and look at the last 6 months because the market has truly done absolutely nothing in the last 6 months. The Dow Jones is down 0.33%. The S&P 500 is down 0.89%, and the NASDAQ is down 0.6%. Also, when I say that the stock market has done absolutely nothing, what I mean is that we are at the same levels that we were 6 months ago. I really want us to think about this. Of course, the stock market has done something. We have seen exponential growth as soon as the market anticipated Trump taking the presidency. You all know how I feel about rapid growth. It makes me extremely nervous. I do not like it. I am the person that gets excited when I see a down market, and that's what we are in. All of the growth that has taken place in the last 6 months has been completely wiped away. And so I want us to really reflect on this because right now is the time when we should be building our portfolios. This is a time when we lean into all of the gains that the market has lost. This is where we build strength. Now, with that being said, I also want to highlight a very dangerous trap that starts to take place in and around these times. Just because we are looking at inexpensive stocks or cheap stocks across the market, that does not mean that we should buy everything that has gone down. There will be stocks that will not recover. Most of these will be speculative stocks. What we need to be leaning into right now and what we need to be strengthening in our portfolios are blue chip stocks. Stocks that we know that the United States of America is dependent on. Stocks that we know that the world is dependent on. Do not make the mistake and look for speculative stocks that right now may be very cheap. They are cheap for a reason. Build the stocks that are strong but are inexpensive at the moment. When we look at patterns in the market, there's also something really important that we need to consider. Historically, early March has been a strong month typically. However, again, we are in this post-election year where the same rules do not apply. Historically, the stock market has been known to perform much better during a Democratic era versus a Republican era. However, on the flip side of that, during a Republican era, the dollar has been much stronger. So knowing that historical component to the stock market, it really can help prepare us to understand that we may not expect a lot of gains during these next 4 years. And this is exactly the time that we should be leaning in to our portfolios and building all of our positions so that we can prepare for the growth that will take place during a Democratic era. What's also really important for me to highlight here that most people that invest in the stock market are Republicans. And so they win whether we are in a Republican era or a Democratic era. They win because they get to build their portfolios and they get to reap the gains from their portfolios. Meanwhile, the majority of us are not participating, and that is where we lose. So I want us to just get our minds prepared around all of this. And it's important for us to understand that these historical patterns might be by design, because the way you truly build your wealth is during a down market.
This episode is brought to you by Progressive Insurance. Fiscally responsible, financial geniuses, monetary magicians. These are things people say about drivers who switch their car insurance to Progressive and save hundreds. Visit Progressive.com to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states or situations.
Look at him, eating whatever he wants, never gaining a pound. While I'm stuck with the boring special and can't lose an ounce.
How's your lunch, man?
Amazing. Yours?
So good.
Oh, I'm so happy for you.
Cool, buddy.
Weight loss isn't fair, but Mochi Health is. The affordable GLP-1 source that can fix your frustration with food.
So, same time next week?
No!
Definitely.
And your friends. Learn more at joinmochi.com. Mochi members have access to licensed physicians and nutritionists. Results may vary.
I want to share with you all an investment case study that I pulled from the Stock Traders Almanac under a section where it goes over the historical patterns of the market performing better under Democrats and the dollar holding up under Republicans. In this case study, it says that a $10,000 investment compounded during the Democratic era would have grown to $757,419 in 60 years. The same $10,000 investment during 64 Republican years would have appreciated to $115,682. That is almost 7 times growth under a Democratic era. Can we really think about that for a moment? It really behooves us to have these moments where we have Republicans in office and utilize opportunities that are at our disposal. Now that we've reviewed the last 6 months of the market and we have identified that we are in a buying opportunity, well, actually, before I go into what I'm going to say, I want us to pause right here because I want to take a little bit of my glory and I want to remind you that 3 months ago, for my folks that have been invested in the market for 5 years or more, I told you this is a time to consider selling out of some of your stocks and consider rebalancing your portfolio because I felt like we were hitting an all-time high and it was going to be downhill from here. And so I just want to say, for the record, that was the right decision. And now here we are, and we are in a buying opportunity. Now, and when I say that, I say it with a grain of salt. This doesn't mean that we've hit the bottom, okay? We have news that is going to continue to make the stock market turbulent, and that's what we're going to get into next. But this is when you start to buy in your portfolio and lean into the opportunity that we have. I know I keep saying that over and over, but I just want to drive the point home. GDP. What is it? Why is it important? And why can it potentially make the stock market volatile? Now, GDP stands for Gross Domestic Product. It measures the production of goods and services. And most importantly, it tells us whether or not we are in a recession. In order to identify a recession, we need to have 2 consecutive quarters of a declining GDP number. That has always been how we calculate a recession. However, during the Biden administration, they changed how we calculate a recession. probably because they didn't want to have a recession under that administration. And so they added the clause that, yes, it is 2 consecutive quarters of declining GDP, but it is now also includes a weak job market. So even though historically it's always been 2 consecutive quarters, at the time during the Biden administration, we did have a really strong job market. And so they used that opportunity. I'm just going to say it and be completely transparent. I think the reason they did that is to remove fears of a recession, gaslight. I don't know. I am very upset that that was done. We'll see if that new definition holds up or if we go back to the original historical definition of a recession. So the problem here is that we did have 1 quarter of declining GDP in Q4. So Q4 of 2024, the GDP was at 2.3%. Analysts were expecting a 2.5% GDP. In the quarter prior to that, Q3 of 2024, we had a 3.1% GDP. It was revised. Originally, the GDP came in at 2.8. Analysts were expecting a 3.1, and then it was revised to a 3.1. This was in Q3 of 2024. So we went from a 3.1 to a 2.3. Now, in Q1, if we have a declining GDP, then we are going to be in a recession. And so there are, of course, concerns, and the market will absolutely react because if there's less growth in the market, that is a direct hit on publicly traded companies. And so we will start to see the effect on earnings reports and across the board in households. The GDP numbers are set to be released on April 30th. We, of course, already have analysts that are anticipating a declining GDP. So we will wait to see how much volatility that will bring into the market. But I think that this type of news is what is going to hold us back from entering any type of rally, unless something spectacular happens. Now, up next, as I mentioned earlier, we have tariffs. So those two in combination, I think, is going to keep us here in and around these levels. Again, we are in a buying opportunity. There's never a reason for us to fear recessions. Millionaires are created during recessions. This is a time where our money can grow. It's an opportunity to lean into all of that, even if it's just spending your time learning about how to invest. That is also a type of investment. Learning about recessions, learning about the economy, that is also an investment that takes $0. It does cost time, but it is time very well spent. This has been your weekly update on Investies. I hope you enjoyed this week's episode. If you did, do me a solid. Can you please rate and review this podcast if you have found any value in it? I appreciate you taking the time to do that, investing it in myself and in my team. When you rate and review a podcast, it really helps to amplify the podcast. So it is much appreciated. You're listening to Investies, a Cosmic Standard and in Lose We Trust production. A very special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
This podcast is supported by MIDI Health. Are you in midlife? Feeling dismissed, unheard, or just plain tired of the old healthcare system? You're not alone. In fact, even today, 75% of women seeking care for menopause and perimenopause issues are left entirely untreated. But it's time for a change. It's time for MIDI. MIDI's not just a healthcare provider. It's a women's telehealth clinic founded and supported by world-class leaders in women's health. Their clinicians provide one-on-one, face-to-face consultations where they truly listen to your unique needs. They offer a full range of holistic, data-driven solutions that isn't one-size-fits-all care. This is care uniquely tailored for you. At MIDI, you will find that their mission is clear: to help all women thrive in midlife, giving them access to the healthcare they deserve. Because they believe midlife isn't the middle at all. It is the beginning of your second act. Ready to feel your best and write your second act script? Visit joinmidi.com today to book your personalized, insurance-covered virtual visit. That's joinmidi.com. MIDI, the care women deserve.